And I want folks to think about that because I think we're in a bull market now. And don't waste it. There's a whole bunch of ways you can waste it. And we're going to talk about that a little bit. I think we are finally into that long awaited event, which is to say, a gold bull market. Now, I'll talk more in a minute about gold markets, but thinking about that reminded me years ago in the middle part of the decade of the 1980s, driving through Midland, Texas, after the oil bull market had collapsed and there was a vicious bear market. And I remember seeing a bumper sticker on a car in Midland, Texas, and the bumper sticker said, "God, please give me one more bull market. I promise not to waste this one." And I want folks to think about that because I think we're in a bull market now. And don't waste it. There's a whole bunch of ways you can waste it. And we're going to talk about that a little bit. But I want to talk about the anatomy of a gold bull market. And I want to use the visual of a circus master's whip. Visualize the circus master's whip. The front of the whip, which moves first, is the metal itself. And I would argue that the metal has been in a primary bull market for some time. One would argue going as back as 2000, but I don't think it has to go back that far. When the momentum is established by gold, that does two things. It attracts other people to the narrative, but it also increases the biggest and the best producers' margins. We've talked about this at the classroom before. In the beginning, not much happens, perhaps because the cost of producing gold might go up as fast as the gold price does. But over time, the increase in the gold price allows producers' margins to expand. We saw that in 2024 with not as much price follow through as we would have expected. But after a couple of quarters of above average earnings, what you see is that the biggest and the best of the gold stocks begins to move. And we've certainly seen that with conference exhibitors like Wheaton Precious, Franco Nevada, and Agnico Eagle. Those stocks, big stocks, have seen just absolute blowout earnings. And the consequence of that is that those stocks have screamed. That has happened in all the previous precious metals bull markets that I've inhabited. What happens is that valuation discrepancies begin to appear. We talked about this in the M&A the M&A discussion that we had last week, but valuation discrepancies occur. And one of two things happens there. Either value conscious investors, people like myself, frankly, begin to look for better relative value lower in the quality chain, or the big companies with higher share prices take over the smaller companies with lower valuations. And this proceeds all the way down the chain until the end, the penny dreadfuls, which are the tail of the circus master's whip. They move last, but they move the furthest. And when they move the fastest. Rather than pay attention to the whole bull market, I think the thing that you need to do is identify who and what you are. Are you an investor? Are you risk averse? If so, just capturing the beta in a gold bull market is sufficient. If you study prior bull markets, what you see is that the market itself can generate between 250 and 500% returns, peak to trough. If you underperform that a little bit by owning the biggest and the best companies and de-risking it, you've done fine. If you were the self-actualized kind of investor who pays attention to the real classroom, you need to think about the juxtaposition between risk and reward. And again, I want to give you a visualization tool. For those of you who are as old as I, at least, think about a yardstick at a fabric store or at a lumber yard. Think about the left side of the yardstick, 0 as representing very low return and very low risk. And think about 36 inches as representing very high return and very high risk. What most speculators want to do is they want to bend the yardstick, which is to say they want low risk and high return. The problem is that if you do that, you break the yardstick. You end up with nothing. And I want you to visualize for yourself the juxtaposition between risk and reward, because the real risk in this market is going to come from your own mistakes, not from the market itself. I want you to think too, in the discussion about the bull market, about the fact that it won't be consistent. It won't be stair steps to heaven. It will be more like a rodeo, higher highs to be sure and higher lows to be sure, until it's run its course. A couple things about that you need to know. In my formative years, 1970 to 1980, my first bull market, rip-roaring bull market, if ever there was one, in the middle of that bull market in 1975, the gold price fell by half and the gold stocks fell by more than that. A 50% decline in the gold price didn't derail the bull market, but it did derail it for some participants. So understand that a break in the gold price, even a psychotic break in the gold price, could occur as a consequence of dramatically higher near-term interest rates. That will occur. In 1970, we had dramatically higher interest rates, which cratered the gold price. It cratered the bond market, it cratered the stock market, and it threatened to crater the real estate market. Congress and the Fed lost their nerve, backed off on interest rates, and then it was off to the races with gold. Specifically, at the beginning of 1975, the gold price is at $200 an ounce, having risen there from $35 an ounce. In the course of the year 1975, the gold price fell from $200 to $100. That 50% decline took out a lot of the faithful, or so-called faithful. Those who weren't shaken out, or those who added to their positions, saw the gold price in 5.5 short years go from $100 an ounce, to $850 an ounce. So there's a lot of lessons here. One lesson is that there will be a lot of volatility and there will be a lot of opportunities to be shaken out. The next thing is that if you right size your participation in the market, if you have money invested that is consistent with your psychological and financial ability to take risk, you will be better able to deal with the volatility that will certainly come to you in the course of this bull market. The last thing I want to say is that you need to have a selling strategy or a variety of selling strategies. I asked myself some time ago, what would cause me to sell my gold? What would cause me to walk away? And what that would have to do with was an unwinding of the circumstances that caused me to buy my gold. Specifically, for me, I would need to say that there was no further need for quantitative easing. I would need to see a balanced or nearly balanced federal budget. I would need to see a rational plan for servicing the net $30 trillion in on-balance sheet obligations confronting the US taxpayer. I would need to see a politically feasible plan, other than a devaluation of the dollar, to deal with the $100 trillion in net present values of unfunded government liabilities, Medicare, Medicaid, Social Security, federal government pensions, military pensions, and the like. And I would need to see a positive real interest rate. And let me describe that a little bit. The US 10-year Treasury pays about 4.5% right now in a currency that I believe is experiencing a loss of purchasing power at about 7.5%. The idea that I get paid 4.5% in a currency that's losing 7.5% means to me that if I own the US 10-year Treasury, I'm losing 3% a year compounded for 10 years. Hardly a good deal. In order for me to say I was receiving a positive real interest rate, the interest rate on the 10-year Treasury, the world's benchmark savings and investment instrument, would have to be 100 or 150 basis points above the deterioration of the purchasing price of the US dollar, which is to say a 10-year Treasury yielding something like 9 would work for me, unless the underlying rate of deterioration of the US dollar fell. Putting that 9 in context, that would suggest a prime rate in double digits. It would suggest a 30-year fixed mortgage in the range of 12. A set of circumstances that would be very difficult to confront in today's economy. I lived through the last time we did that, the decade of the 1970s. In the 1970s, the prime interest rate went up almost fourfold. And it was an ugly, ugly, ugly set of circumstances. Although by the end of the decade, we had dealt with inflationary expectations. We had dealt with an awful lot of things. It is my personal belief that past is prologue. In the decade of the 1970s, the purchasing power of the US dollar declined, according to the Congressional Budget Office, or its predecessor, by 75%. And my suspicion is in the next 10 years, the purchasing power of the US dollar declines by 75% in absolute terms. Again, if it were, that is to say, if the purchasing power of the US dollar declined by 75%, we would deal with the net present value of off-balance sheet obligations by in effect devaluing them. And that's the way that I think ultimately we're going to have to deal with them. This is all very bullish with gold. You have to understand these arguments and agree or disagree. And you need to think through how you're going to participate in the bull market. You need to think through too how much risk you're willing to take, where you're going to be on the curve, and how much of your net worth you're going to risk on being right or being wrong. Let's revisit the first statement. God, please give me one more bull market, pardon me. I promise not to waste this one. We're in one now. Don't waste it.